Yeah.
Yes.
Okay.
Okay. So, a warm welcome to everyone to the Q1 FY21 results of Bank of Baroda. Hopefully, everyone is safe and doing well. We first of all apologize for the delay, and we have uploaded the presentation on the link, and so we can directly start with the opening remarks by MD, and then we will be taking the question and answers, which will be followed by the closing remarks. Over to you, sir, please.
Thank you, Samir. A very good evening to everybody. We had some challenges in terms of our auditors in Delhi getting results signed. So I'm sorry again for the delay which has been there. I do hope everybody is well and all your families are doing well. This is now 1 year since the bank reported its first results post-amalgamation for June of 2019. So to that extent, it has been an eventful year. The impact of the merger, which is of course going to be beneficial in the medium term, but the short-term impact is something which has been there always are challenges, and then of course COVID. You have a copy of the presentations. I would just request you to make sure that you download the latest copy and have a look at that, because there are some figures which have changed, I think, over the last hour or so in terms of the analysis. Nothing material in terms of results, but in terms of some growth ratios which have been given. So I would just request you to look at, just have the latest version. So we'll not go through the entire presentation since you have a copy, but I'll just dwell upon 5 main themes which I believe are important and which we can discuss, and which I also think would be the major part of your questions. So first is again, Samir, if you can just move to the first slide, please. So this is again the figures that you would have, right? I think Samir, is these figures again. The one is the old figure which is there in terms of growth piece. Samir, you're there?
Samir, you are on mute.
Yes, sir. Yes.
So you have the first slide is the one that you are the figures that the growth ratio you need to change, right?
Right.
So would you want to bring it up again?
Yes, I will bring it up again.
Okay, I'll just start speaking anyway. So fundamentally what we see is, some of these figures will change slightly, but fundamentally what we see is that despite the challenges that have been there on account of the merger and also on account of the COVID-19 situation, the growth impetus of the bank remains pretty much intact, and we have been gaining a fair bit of traction in terms of business as we have gone along. On the deposit side, we have both in terms of CASA as well as in retail term deposits, we have seen very good figures which are at par with industry or better. CASA has gone up by 11.9%, and in the process, the CASA percentage has moved up by nearly 3 percentage points, from about 36.5% to 39.5% YOY. Retail term deposits have similarly gone up by 10.4%. The overall deposit growth has been more muted at about 4.3%, because we have been very careful in pricing our deposits and making sure that the deposit growth is closely aligned to the advances growth. As a consequence, the CD ratio has actually gone up significantly during this period, from about 78% to 81%. So that's been a significant improvement. Going ahead also, we would want to make sure that we align our deposit and our advances growth. On the loan side also, again in most heads, we have seen growth which has been pretty much at par with industry, in some measures better than industry. Net of pool purchases, home loans have grown by 10%. Education loans have again grown in the mid-teens, and car loans have grown by about 26%. The overall growth in retail loans has been about 13.5%, aligned to the corporate loan growth, which has been about 8.9%. You end up with a total advances growth of nearly 8.6%. So overall, we have had very good, robust growth despite the challenges which were there. And if you were to look at the slide which is there on the right hand side, the YOY change in advances would suggest that the momentum has been gathering pace as we have gone. In the quarter ended June, it was 5.86%, and then post-merger, as the challenges were there in terms of integration, it came down to nearly 3%, and now over June 20, it has moved up to 8.6% growth YOY. So to that extent, I think we are seeing a gathering momentum. Along with good growth in business, we have seen improvement in asset quality. The gross NPA ratio has moved down by a percentage point from 10.28% to 9.39%. The net NPA ratio is down by more than 1 percentage point from 3.95 to 2.83%. The slippage ratio this quarter is down, possibly understandably, from 3.56 to 1.64. But I would want to draw your attention to the domestic slippage ratio, because there were some one-offs which were there in the international book, which is down from 3.9% to 0.45%. So all in all, we have been able to deliver both a fairly good growth in terms of business figures, both deposit and advances, and also a significant improvement in asset quality going ahead. The PCR now stands at 83%. So the question, of course, is that if our loan growth has been good, our deposit growth is mostly composed of CASA, then why is it that we actually have reported a loss during the quarter? So this is largely on account of the increase in provisioning standard assets. If you were to look at the presentation, there was actually a back of provision of about 100 crores last year in Q1 on account of standard assets. As against that, there is about 1,800 crore provision on standard assets this year. Part of it, of course, is on account of the COVID loans, which would have skipped otherwise, about half of it. But the other half is on account of actually a standard asset, which is guaranteed by the government. But where, because of the 7th circular, requires that in case you are not able to do restructuring or take an account to NCLT, and in this case, both are not possible, you are required to make a provision. This circular does not, as of now, distinguish between government guaranteed accounts and others. So therefore, we made a provision. We do believe that this provision over the next few quarters, as the situation resolves, would get written back. So we see this provisioning as something which will be available to the bank for, again, COVID-related stress should it arise, as this gets released in the subsequent quarters. The total amount of provisioning we hold against this loan, which was provided both in the last quarter and this quarter, is an aggregate of 2,500 crores. Out of that, about 1,000 crores came this quarter. So that is really the context in which there is a loss, and which is how we actually square the circle, that you have good growth in deposits, good growth in advances. NII has gone up by 5%. Slippages have come down, but nevertheless, there is that little, that is the figure which is there in terms of loss on the account. Along with that, the other interesting piece is the moratorium, which I believe would be a matter of discussion today. So you might recall that in the first round of moratorium, BOB had given an opt-out clause for all our customers, and the moratorium came out at a relatively high figure, at about upwards of 60%. In the second round, from June, we decided that only accounts which are up to 10 lakhs, we would actually do a moratorium. It would be opt-out. For everybody else, it would be an opt-in. As a consequence, the moratorium figure has come down very significantly. And we have tried to, again, express it pretty much in a standard way, because all banks were doing it in different ways. So the moratorium term loan book, which is under moratorium, as a percentage of total loans, is today 21%. I repeat that figure. Term loan book, which is under moratorium, as a percentage of total loans, is today 21%. And for this, what we have taken is the all loans where the last installment has not been paid. So even if 2 or 3 installments have been paid, but the last installment has not been paid, we have taken that as a loan which is under moratorium, and the figure there stands at 21%. Of this, the ones which are at part of opt-out is about 5.74%, as you would see, and the balance 16% is the loans which have opted in for the moratorium. If we were to take a definition of, say, where 2 installments have been paid, this 21% figure would drop down further to 17%. So to that extent, we have seen a very significant improvement in the position in the loans under moratorium, which is in line with the guidance that we had given earlier, that a lot of people who were opting for moratorium only to preserve liquidity, not necessarily because there was an inability to pay. The last piece which I would just mention briefly before we can move to questions is our amalgamation exercise. So this is moving apace, both in terms of rationalization of branches, which is resulting in significant cost savings. We have targeted 1,300 branches to be rationalized, which is a significant part of the cost base and the network. Out of that, about 900 have already been co-located. And the balance will be done within the next few months. And in terms of the executing the entire amalgamation process, we expect to complete that within this financial year fairly comfortably, despite the 3 months which were lost on account of COVID. Also, the targeted savings which were supposed to accrue, that again 99% of those savings have accrued to the bank. So in summary, the amalgamation process is absolutely on track. So with that, I'll end the opening remarks. Very happy to receive any questions that might be.
So the first question is, should we start?
Yeah, please. Yeah.
So the first question is on what were the additions to and downgrades from the watch list during the quarter? What would be your total? Yes, sir.
I think I can see the question. So one is on account of the downgrades from the watch list and the total outstanding standard asset provisions, including general provisions, and sharp rise in watch list from NBFC sector, right? These are 3 pieces.
Yes, sir.
Okay. So I think the addition to the watch list is the answer, I think, lies in your third question, right? This is mostly on account of the NBFC which we have added to the watch list. That accounts for the major addition. In terms of downgrades, I think of slippages, 90% have come from the watch list. But having said that, the downgrades during this quarter are relatively small, right? In terms of the total outstanding standard asset provisions, excluding general provisions, maybe again, Samir, you can give that figure.
Right.
Yeah.
The total provisions.
Standard asset provisions.
Yes.
Otherwise, I can fill it out.
Yes, sir. So the total provisions for standard assets during the quarter were 1,811 crore.
No, total amount of provision that we hold against standard assets. I think that's the question, right?
So the total
outstanding standard asset provisions.
Yes, we'll just get that.
Yeah. Okay. Yeah, Samir, we'll go to the next question, please. Meanwhile.
Yes, sir. So the next question is, sir, for which segments will you do one-time restructuring? Will there be more restructuring in retail? Why has the NBFC watchlist gone up?
Yeah. So I think in terms of which segments one-time restructuring, I don't believe again this is something which is necessarily going to be segment specific. But clearly again, if we look at the composition of our book, I would suspect the largest portion would come from corporate loans. Simply because of the composition of the account which are under moratorium. Of the 21% accounts which we are under moratorium, about 10%, about half are accounted by corporates. In MSME, we believe there would be some restructuring, but partly because of the fact that they are other schemes which are available, including 20% increase in fund-based limits guaranteed by the government. We believe there are other possibilities which are there in terms of supporting MSMEs, but the corporate book is likely to be the single largest component of that. As far as retail is concerned, yes, the possibility of restructuring is there, and it is also true that as far as retail loans are concerned, there would be some stress simply because of the impact of COVID in terms of the personal incomes of people. Having said that, the quality of our retail book is very robust. Nearly 74% of our retail loans are those with credit scores of 725 plus. So therefore we believe, and also the proportion of unsecured loans is relatively small in a retail book. So therefore we would believe that our retail book should hold up relatively well, but nevertheless we should again be looking at, we open the possibility of some restructuring which is required, but to repeat again, the much the larger percentage ought to be the corporate book. The NBFC watch list has gone up only on account of one single large account which is there, which remains standard, which is also reasonably highly rated, but which we believe shows some signs of stress. So therefore we have gone ahead and put that on the watch list.
Sir, should we move to the next question, sir?
Yeah.
And sir, the total standard asset provision is 7,906 crores.
Yeah. Okay.
Answer that. Okay.
Thank you. But just again, to emphasize on the NBFC piece, that overall our NBFC book tends to be very, very good quality. We are comfortable with the quality. There's only a one-off account which we have put on the watch list. But otherwise, if we are looking at the risk profile of the NBFC book, I think what you would find is, again, and this is there on slide on page 16 of the presentation with you, that the percentage of books which is private others, which means those NBFCs which are not backed by central or state governments, PSUs or large private institutions, has come down from 34% to 27%. The overall book, which is rated AAA and AA, continues to be very high at about 89 to 90%. So we are very, very comfortable with the overall quality of the NBFC.
Sir, the next question is, the moratorium is 21% of the term loans, or 21% of domestic total loans, or 21% of total loans?
Come again?
So the question is, is the moratorium 21% of term loans, 21% of domestic total loans, or 21% of total loans? So that, yeah. I think you've already explained that it's 21%.
Yeah. So it is. So 21% of our term loans are under moratorium. 21% of our book is under moratorium. This is composed of term loans.
Yes, sir. And this is a percent of total loans. Correct. That is the answer. Yes. So the next question is on the watch list of March 20 is 12,500. So any color or clarification on that? And now it is at 13,000 crore.
Yeah. So I think this is the point that we made earlier. The increase in the watch list is mostly on account of one NBFC, which we have put on the watch list because we believe that the portfolio of the NBFC is showing some signs of stress. That is the single largest addition of to the watch list, which accounts for the increase on the watch list.
Right. So the next question is on the quality of the below triple B book. In terms of some quantification or color, which is there in slide 14.
Slide 14, let me have a look. Okay. So this is loan accounts which are above 5 crores. So the quality of the book continues to be good, in as much as that the fact that these accounts are rated AAA is more on account of the fact that these are normally medium-sized enterprises, and which have balance sheet structures which can require them to be rated BBB. Otherwise, in terms of, if you were to look at historically the stress levels, our BBB book is of fairly good quality, and it is something which has held up well. Also, the fact that the moratorium has come down precipitously after we chose to have an opt-in for all borrowers above 10 lakhs would suggest that the quality of the book remains pretty good. So we actually have no reason to suspect that the BBB book is in any way significantly more prone to stress. Of course, the fact that account is rated BBB would mean that the quality of the account is lower as compared to A-rated accounts, but otherwise the BBB book is of good quality in my assessment.
Right. So the other question is, what are the outstanding provisions on standard global assets? I think the earlier one was also there. So we've already shared the breakup for domestic assets was 7,906. If we take the global one, that number will be approximately 9,000 crores. So the next one is quantify the unrealized MTM treasury gains.
This is something which unrealized treasury gain.
Market.
Yeah, so I think this, I don't really have an answer. Maybe you have an answer, or would you believe there's if Mr. Downgrades is on the call, maybe he can answer that.
Right.
Sir, Surat here in STF category it is 8,900 crore on 30th June.
Okay, so there's the answer. Okay, so we can move to the next question. That says, can we have the standalone balance sheet for the quarter? That we've already uploaded, so that is not the issue. The next one is, sir, what is the term is what percentage of the overall loan book?
Come again?
Term loans. So term loans, what is the...
What
this
number
is question number 11, sir. 11.
Okay, yeah. Term is what percentage of the overall loan book? To my mind, it's nearly 50-50. Is that of
slightly higher, sir. I think it will be approximately closer to 65-35 kind of ratio.
Okay, all right.
Right. Okay. Sir, we move to the next question.
But as well, you can just make sure you can send the specific answer so that we can get the exact breakup, please.
Right, that we will send it. Yes. So the next question is some color on the moratorium on working capital, and what is the total exposure to government guaranteed account, both funded and non-funded? And then the third question subpart is the NIM outlook.
Yeah. So I think we can send you the figures on the working capital. Here, of course, I think the point is that it is only interest which is again not being paid for the period of moratorium, and which again will be put into FITL and paid in this financial year. So that is why this is not something which is taken as part of the computation, but the figure is available and we'll give that to you. Samir has the figure. I think he can give you on the call, or we can send to you immediately after that. The total amount of loans which are again guaranteed by the government is something which we can again provide. Not readily available for the moment, but we can give you that figure also. But I think what we need to bear in mind is that it is not the issue of government guarantee which was the point. The point was that there is actually a June 7th circular, and which again makes provision for you're providing against a loan 20% in the first instance, moving up by another 15%, 35% in case you do not take account to NCLT. And this circular does not make a distinction specifically between a government guaranteed loan and otherwise. So the point that we had made was only in the limited context of the June 7th circular, not government guaranteed accounts per se. The last part was in terms of NIM outlook. The net interest margins are certainly going to be a little bit under pressure, for the reason that with in a liquidity surplus situation, yields on some credits are coming down, but we have been able to contain that because of the fact that in terms of deposit growth, it has mostly come from, in large percentage it has come from CASA. And going ahead also, our endeavor would be to make sure that deposit growth is on one hand contained pretty much in line with the loan growth, so that the impact of the liquidity overhang is minimized. And second, to make sure that in terms of composition, the deposit growth comes as far as possible from CASA growth. Our CASA has moved up from about 36.5% to 39.5% over the last 1 year, and we are targeting to take it up further to about 42% by the end of this year. But again, given the way the liquidity is playing out, we believe that it is possible that there could be some further pressure on NIMs, and as of now, our base case is that it could conceivably come down by another 5 basis points or so.
Right. So we'll take the next question. It's on our equity raising plans. So please share your equity raising plans in the future, rights issue, etc., to maintain your share in the banking business. Please share plans and indications for deposit growth and CASA growth. And then SBI and Kotak have shown satisfactory growth. Please share indications for operating cost, slippage ratio, and credit cost for 2021.
So that's quite a bit. Let me see, what is this question number so I can just make reference to it when I...
13.
Number 13. All right. So I think the equity fundraising plans are something which we have published. We propose to raise a total of 30,500 crores by way of equity during the current year, 4,500 by way of an AT1 issue, and we are partly through that already. And the balance amount will also be raised in the next few quarters. 9,000 crores is going to come by way of pure equity, and that's something which is possibly, again, we're looking at doing in the second half of the year, subject to market conditions. Now, the exact composition or the option that we would choose on that, rights to choose certainly a possibility, but that's something which we have not frozen as of now. In terms of deposit growth, as I mentioned, we would want to align deposit growth to our loan growth. As of now, we are looking at growth in the loan book about 7 to 8% during the year, and we believe that the deposit growth should also be aligned largely on the same lines, between 7 to 8%, with the predominant proportion coming through CASA growth, which should move up from 39.5 now to as close to 42% as is possible. So in terms of operating cost, I think the operating cost has gone up a little during this quarter. Why it is up by a few decimal points? We believe that given the fact that the cost synergies are going to play out over time, but nevertheless, there is fee income in particular has taken a hit in this quarter. If you look at the figures on the income side, it is fee income which is the one which actually has negative growth. NI has grown by 5%, other income it is negative. So as the recovery gathers momentum, we believe fee income would be under pressure YOY as compared to the previous year. So therefore, in terms of cost-income ratio, we possibly might end up on lines which are similar to where we are now, hopefully with some improvement. But we do not expect the cost-to-income ratio as of now to move north of 50%. It should remain well under 50%. The slippage ratio, you would have seen that the slippage ratio has come down during this quarter significantly as compared to YOY. And if you look at the domestic slippage ratio, even more so, because the international slippages, there were some one-offs which were there. And we do expect that the slippage ratio should be significantly lower as compared to the previous year on two accounts. A, because of the fact that we have seen the moratorium book has come down, and B, because of the reason that the RBI restructuring option is available, and therefore a percentage of loans which may have slipped otherwise, the option of restructuring would be available.
Sir, we'll take the next question. This is on what is the reason for decline in CET1 of around rupees 20 billion on a quarter-on-quarter basis? What is the total term loan of the bank? And what is the share of loans which have not paid any EMI in April to July period?
So I think I'll just pick up the last piece first. So this 21% figure that we have given, this is for loan accounts which have not paid the last EMI, which means even if they had paid the previous EMI, we have still computed them as part of the figure under moratorium. This 21% figure, as I mentioned earlier, would come down to 17% if we were to take accounts which have paid two installments as one which are not under moratorium. But we have taken a conservative view, and that is the figure that we have. In terms of the CET figure again, I think Mr. Jain will probably again give you some color on that.
Yeah, reduction in CET is basically 2-3 reasons. One is because of the losses. Second, because of the DTA we created. And the third one is because of revaluation reserves. These are three major factors.
Right, sir. Sir, on that note, we move to the next question. Same thing, what explains the 36 basis points reduction in CET1? So we've answered that question. The next question is the question pertains to the number of 21% given for moratorium. Does 21% refer to total global loans of the bank, or does it refer to 21% of domestic loans, or does it refer to 21% of domestic term loans? So this we've already answered, sir. The next part is absolute number will be helpful to avoid confusion. So we've already answered is 21% of total loans, and we've given the total loan figures. This can be computed. Also, has this number further reduced in July? So this is the July number of 21%. If so, what will be? So this we have already given the latest number. The last part is what percentage of your retail loans are to government employees or employees working for government companies?
So I think we don't have readily the figure of retail loans to government employees, but the figure that we do have is that 74% of our retail loans are to borrowers who have a credit score of 725 plus. So the quality of the retail book is fairly good.
Right. So we'll move to the next question. The person requires a breakup of total savings and current account figure global. So this we can provide it separately. We provide it separately. The next question is, which sectors your credit risk team considers as stressful? What are your views on home loan growth and infrastructure sector?
So I think in COVID times it's tough to again talk of which sectors are stressful, right? Their usual suspects are there in terms of aviation, hospitality, CRE. So our exposure to those sectors is fairly limited. I think it may not be more than 2% of the loan book. So we can come out with the exact figure. I think the figure that we had over 20,000 crores, right? So we can just give you the exact figure, but it's relatively small, particularly if we take out the government guaranteed portion. The other part of the question was on in terms of home loan growth. So again, this is something which we remain comfortable with. Simply because of the way we have positioned our home loans. As we mentioned to you, our loan pricing is something which is very aggressive, but tilted toward those with the highest credit scores. So if a person has the highest credit score, then our home loan rates are the best in the market. In fact, to everybody on the call, I'm sure all of you have home loans, I would request all of you to look at the BOB home loan rate very, very carefully. I'm sure you'll end up saving a fair bit of money there. And as far as infrastructure sector goes, I think it's as much a function of opportunity. And if you were to look at the figures that we have given in terms of industry breakup, our exposure to infrastructure sector has come down from 14% of the book to about 10% of the book. So we are okay in terms of growth in the infrastructure book, but we are very, very careful in terms of quality. And given the opportunities which are there today, we believe that as a percentage, the proportion of infrastructure loans is likely to probably come down as part of the overall loan.
Right. And sir, as you're saying, the credit risk to stressful, those three stressful sectors, as a percentage of domestic exposure, that will be 2.8%.
Yeah. So that is the.
So we'll move to the next question. That's on the domestic NIM has been declining over the last 5 quarters. Where do you see the domestic NIM? Anything that the bank is doing to improve it to 3%?
So yes, first of all, again, absolutely, again, I think it's very important that we make sure that the net interest margin improve significantly. That, to my mind, is going to be a function of the composition of the book. I think part of the challenge, of course, is that 50% of our loan book is corporate. And when it comes to highly rated corporates, I think yields again have been driven down because of the excess liquidity. And the only way you can protect NIMs for the moment is to make sure that your deposit rates come down in tandem. So if you look at our deposit rates, they are pretty much the lowest in the market. And also to bring up the CASA ratio. So we expect that to end up the year with a CASA ratio of as close to 42% as possible, which would pretty much place us among the best banks as far as CASA ratio is concerned. But coming back to taking the net interest margins to 3%, I think we need to rejig our portfolio. For instance, again, when it comes to the mortgage book, mortgage loans as compared to home loans, again, carry a significantly higher rate of interest. So we will be looking at our loan book very, very carefully, very actively within this year to see how we can start pushing up our net interest margins. We absolutely recognize the fact that it is imperative that we push them up to as close to 3% as possible. Although, of course, during the current year, because these portfolio rejigs happen over a period of time, we do expect the net interest margin to be under a little bit of pressure simply because of the liquidity overhang, which is likely to persist for some more time.
Right, sir. Sir, we go to the next question now. It's on is the stressed NBFC infra financing or real estate developer financing? Question number 20, sir.
So we can confirm to you. I presume it would be infra financing, but I think this is something which maybe you can confirm later.
Right. So the next question is again it's similar, sir. What is the NBFC loan under the watch list? So similar question. So
it's a relatively small part of our portfolio. Our total NBFC book is in the region of 110,000 crore and 150,000 crore, right? So I think in terms of the percentage of book under watch list, which is possibly about 2%. So our NBFC portfolio continues to be very strong, very robust. About 90% of the portfolio is rated AA and above. It is performing reasonably well. And a very, very large percentage is supported either by the government, government companies or PSUs, or again very large private sector groups. So we are fairly confident of the NBFC portfolio, and we believe that the one account which has been moved in the watch list is a bit of a one-off, and that too has been done out of prudence.
Right. So the next question is, what is the loss given default historically from our below BBB and BBB rated accounts?
Okay, and I think this is again a lot of statistics which are there. This is from Shashank from Axis Mutual. I think LGD is what is required, and also in terms of corporate book under moratorium, break up in terms of sector rating and all. So I think this is something which probably we'll have to see if we can provide offline.
Right. The next question is, sir, what is the reason behind higher standard asset provisions this quarter? What has been the disbursements under the ECLGS scheme?
So I think we did mention the reason for the higher standard asset provision during the quarter. So this was on account of one account, and also the applicability of the June 7th circular to that. We expect that this provision should again get written back over the next few quarters. And as of now, our assessment is within this financial year, we should neutral as far as extra provisioning is concerned. In terms of the EEC LGS scheme, I would request Kichi Saab to again give the latest figures, please.
Yes, sir. So we have sanctioned almost 8,000 crores, which translates to around 94% of the eligible accounts have been sanctioned, and out of which 5,564 crores has been disbursed. So that translates to 63% of the all eligible.
Perfect.
Yeah. Right, sir. So the next question is, there is a slippage of 2,100 crore from the international book. Any particular loan account which accounts for a large portion of this, and if so, in which sector?
So I think yes. So that is from Sonal Kohli. So I think it's an important question, because this international book slippage is something which is really out of the ordinary. Normally, our slippage is around 300 400 crores. So of this, about 1,100 crores is from one group from the Middle East, where again some issues have come up in terms of the quality of information as far as that group is concerned. The balance amount is composed of two accounts. One is a large diversified group from India, which has where again there have been some issues there. So one of the group concerns, which is headquartered in Singapore, all the assets have been sold off. We expect to get the money by September, and there is 600 crore outstanding which is there. So that is part of the slippage, which means in sum that 600 crore slippage which has happened, we expect a full recovery within 3 months or so. Another 250 crores is on account of a loan out of base, which is Australia. It's again a large group from India, where there is a restructuring which has happened. On account of the fact that there is restructuring, the account has been classified as NPA, and therefore there is provisioning, but the loan is being serviced on time. So the 2,100 crores, about 1,900 crores plus is accounted for the three categories. One large account from the Middle East, and about 900 crores, which is there because of one where the 600 crores we expect to recover the money, and 250 crores because restructuring, which is successful.
Right. We'll move to the next question, sir. What percentage of loans haven't paid a single due between March and July end, which is 5 months? Moratorium is only from the term loans, right? So we answered that it is only from the term loans. What is the moratorium on working capital? Why has the domestic NIM or loan yields declined in Q1?
I think we have answered part of the, I think most of the questions have been answered, excepting the fact that what is the percentage of loans which have not paid a single installment. Look, as far as we are concerned, we are not really focusing on that piece. If people have not paid the last installment, which was the July installment, as far as we are concerned, that loan is in the moratorium. We are taking a fairly conservative view of that. And I think, as I mentioned before, if we were to take people who have paid 2 installments, the moratorium figure would come down from 21% to 17%. So we are being fairly conservative on this, and we actually haven't really got a figure of who has not paid a single installment. If I think it's required, we can come back on that particular piece. So working capital is of course only the interest, and which also will be paid back within this financial year, which is why this is not part of this figure, but we can give that to you separately. In terms of domestic NIM, again, we have answered the question. The decline is actually, I think, if you're looking at YOY, it's about 7-8 basis points. The NIMs have been under pressure, which is mostly on account of the liquidity position which is there and how that impacts the NIMs on the corporate book and the highly rated corporate book in particular.
Right. Sir, the next question is, within our retail loans, what proportion of customers would have a reliability relationship with us?
So I'll request Kijizab to answer the question. My understanding is at least 90% of those people have accounts with us, but Kijizab will give the answer, please.
Yes, sir. This should be around 90 plus % would be having retail liabilities relationship with us. Most of them do have an account. Even if we have new to bank relationship on the asset side, we do develop it into liability relationship also.
Right.
Yeah.
And the absolute number in rupees crore for moratorium, that we'll share it separately. Which we said that's 21% of total loans. Which segment is the NBFC into the one added to the watch list? So that also you've already given a color on.
Yeah.
Done. Sir, one question that has come is what will be the guidance on the credit deposit ratio as well as the net interest margin?
So I think the credit deposit ratio is now settled up upwards of 80%. I think there is still some room to push it up, although I would believe that first you would want to make sure that you optimize the credit cost by taking up the CASA figure to as high as possible. The other part, of course, is that we are in slightly uncertain times, so you might want again to be a little more conservative in terms of liquidity cushions. So, but if you're looking at guidance for the next few quarters, we are looking at growing the asset and liability book in tandem. As of now, we expect the assets to grow by about 7 to 8% in the current year, and we'd want to grow our deposits by a similar percentage.
Right, sir. Sir, the next question is wage revision entirely done or is spilled over to the next 2-3 quarters?
Jensa,
for wages.
Yeah, Jensa, please.
Yeah, we have made a provision of 278 crore in this quarter. We are having a provision of 2,200 crore. And as per the MOU, we are more or less covered. Of course, the final details are awaited, but as per the MOU, we are more or less.
Right. Sir, the next question is on the assessment of impact of the circular on a current account by RBI. What do you, in your opinion, is the assessment of the impact?
Current account circular?
Yes.
I'm sorry again, maybe Jen Sam has an officer may have a better idea about this, please.
As far as current account is concerned, we are having around 667 consortium accounts, and we are having around 210 multiple accounts, so around 875 accounts, and majority of these accounts we are having more than 10% of our shares. So going forward, we should be gainer in this because we are large.
So okay, I didn't probably get the question right. So absolutely. So we will welcome the RBI circular. We believe that this circular should really help us in terms of maintaining credit discipline, and it really is a big help, and we want to implement it again as diligently as we can.
Right. So the next question is, how much has the bank provided against standard NBFC exposure under watchlist? And the highest slippages from the international book in recent quarters, any color on the same? That you've already given a color. And this detail we can share separately in terms of what is the exact provision under the standard NBFC account that we provided for. Sir, the next question is, what is the amount of interest accrued and deferred that has been booked in the P&L in the quarter?
Okay. Again, Jensap, if you have the figure readily available, I will need to probably provide that later.
Yeah. That information will provide. But fact remains that all working capital accounts we are booking interest, and it is a part of our income. Of course, as far as capitalization is concerned, that will be after August only.
Right. So the next question is, as per the last Finance Ministry disclosure, Bank of Baroda has approved only about 8,000 crore under MSME guarantee scheme. But the broader question is, why is the cumulative approval from banking system very slow and is only about 1.3 lakh crore still? Are MSMEs declining the declining the takeout of funds, or banks are more reluctant? Some thoughts will be useful based on your discussion with SME clients.
So I think I can only speak for Bank of Baroda. I think Mr. Khiti just now mentioned that of all accounts which are eligible, right, and the eligibility criteria has been very clearly laid down by the Government of India. Of all accounts that are eligible for assistance, 94% have already been sanctioned loans, right, and more than 60% have already been disbursed. So I think as far as BOB is concerned, we believe that this scheme of the government is very timely, very useful, and we would want to do our best to make sure that we can help our customers access credit under this scheme. So I don't think there's any challenge at all. Now there's been an expansion of the definition, and we make sure that we similarly help the clients who are part of the enlarged definition.
So the next question is, again, it's similar, sir. What is the impact of the new regulations of the current account circular by RBI? What will be the impact on the bank in the medium term?
So I think for us it's a salutary impact. So I don't believe that there are too many cases where people have got loan accounts somewhere else and they have current accounts with us. It's mostly again the other way. So the bank will greatly benefit from the credit discipline that this will instill among our borrowers. And I think given the challenges that we have had in terms of issues like diversion of funds, I think it's in the enlightened self-interest of our borrowing clients also to make sure that the current accounts are kept with the lending banks.
Right.
So if I add on that, I think the report that is coming right now is for all the PSU banks. Almost 65% have that credit, but 45% current account. So it's basically in our favor. I mean, these guidelines are definitely going to be good for us.
So if in corporate book, 48% of our loan book is corporate and 14% MSME, 62%. So we will be gainer from this circular.
Right, sir. So the next question is also, there are two parts to the question. First is on the current account guidelines again, which we have explained. The second one is if you can quantify the stress government account for which the bank has made higher standard asset provision. I believe, sir, this also you've already explained, so we can move ahead. Sir, the next question is, what is the other adjustments of rupees 700 crore as part of reductions from the asset quality movement?
Yeah, basically, in one account, we have structured and part of the outstanding has been shifted to our investment book, and that is why this is. Because we cannot consider this as a recovery. So NPA has been shifted by way of an equity or an preference shares and movement. Of course, the provision is also.
Right. So the next question is, kindly share proportion of your, kindly share the proportion of your working capital loans under moratorium. This we can share separately, or we'll add in the presentation given the need. The absolute amount of global CA and SA balances also we'll share, sir, separately. Is the NBFC added in watch list a domestic exposure?
Yes, indeed, it is a domestic exposure.
Sir, the next question is, you were quite confident of the NBFC book last quarter, but now we have shown 1,800 crore increase in the NBFC watch in the watch list in the NBFC sector. What is the reason for this deterioration?
So I think the fact is that in any book there will be some accounts which will be under stress, right? And the NBFC book is no different. But I would want to emphasize that if you look at the overall loan book and the overall size of the watch list, the overall size of non-performing assets, I think the NBFC book stands up well, and that is largely on account of the nature of the NBFC book. As I mentioned before, 90% of the NBFC book is rated AA and above. So we are that is the reason why we are comfortable with the NBFC book. It is not again that the NBFC are not having any challenges, but the quality of the NBFC book that we have, we are comfortable with that. And this one account being put under watch list, to my mind, is not again any kind of reflection on the overall portfolio. I think if there were to be no account on the watch list, I think that would be worried whether we actually are monitoring a portfolio carefully or not.
Right. So the next question is, we've already taken it up. What are your views on the current account guidelines issued by RBI? What are the expected gains for you, Penny? We've already taken this question.
Yeah. So I just emphasize again, the gains are going to be more in terms of credit discipline, not so much in terms of current account balances. Because if your credit account is with them, then they will go towards, again, those loan balances coming down. But the credit discipline is invaluable as a gain for the bank.
Sir, the next question is, what is the total exposure to the single asset which is government guaranteed but delinquent, and we have provided rupees 25 billion?
Yeah. So the total exposure is of the order of about 7,600 crores. Out of that, about 5,800 crores, I think, is guaranteed by the government. And we are carrying today a provision of about 2,500 crores against it, because, as I mentioned, the rule book says that in the first instance, if you do not take an account of the NCLT or restructure, you provide 20%, and after elapsing of a certain period of time, this moves up by another 15%, 35%. So we have gone ahead and done that. Because technically, the circular which is currently there does not make a distinction between government guaranteed account and others.
Right. And sir, the next question is, what is the provisioning that we have done for the weak overseas asset?
So I think I possibly answered that question in some form. So the provisioning is done as per standard provisioning norms, which would mean that in some substandard asset, the bank provides 20% in the first instance. But in this particular quarter of the 2,000 odd crores which has slipped, about 800, 900 crores is on account of two accounts. One is where we expect recovery within 3 months, and in the other, it's a restructured account where restructuring is performing over a period of time. Even that should get written back.
Right. And so the next part is the residual watch list in the overseas book pertaining to the same week group?
Residual watch list, I think I'll confirm that. I think it's possible, but I'll just have to look at all the details. We need to just come back to confirm. It seems to be a logical deduction, but we just need to confirm that.
Right. And sir, again, this question is repeated, so we've already answered this. Apart from that, sir, again, this is the last question is again on the current account framework. How would it impact Bank of Baroda? So that we've already answered. And sir, let me see if there are any few fresh new questions. Otherwise, I think we are pretty much at the end of the call. We just check in the next minute or so. No, so I think that was the last question, sir. So whatever details we have not provided, we will send it individually to the person who have asked the requisite question. And sir, so would you like to give some closing remarks, or we can close the call?
I think thank you very much for everybody for being on the call. It's been late in the evening, and again, really thankful for your joining in. Please keep safe, and thanks once again. Hope to catch up with you soon, certainly next quarter.
Right. Thank you, sir. So thank you everyone for joining us on this conference call, and look forward to seeing you again. Thank you, sir. Thank you.
Thank you.